Imagine getting a paycheck from Wall Street every single month, not once a quarter, not once a year. Every 30 days, cash hits your account. Today, we're breaking down 4 U.S. stocks that actually do this: Dynex Capital, Capital Southwest, Eagle Point Credit, and SL Green Realty. All monthly dividend payers, all with very different risk stories behind those juicy yields. By the end of this video, you'll understand 3 things for each stock: what the company really does in simple language, why the yield looks so attractive, and what kind of risk the market is quietly paying you for, so even a beginner can decide whether this type of income makes sense for their own portfolio or not. This is pure education, not financial advice, so always do your own research before investing. Let's start with Dynex Capital, ticker DX. Think of DX as an interest rate machine. It borrows money and invests in mortgage-related assets, trying to lock in the difference between what it pays to borrow and what it earns on those mortgage securities, which is called the spread. Over the last 12 months, Dynex has generated roughly $230 million in revenue and around $175 million in profit. And on top of that, it pays a monthly dividend that adds up to about $2.04 per share per year, giving investors a very eye-catching yield of around 15% at recent prices. Here's the part most new investors miss. To create that kind of income, DX uses a lot of leverage, with total debt more than 5 times its cash and equity and a debt-to-equity ratio above 6. And its payout ratio has recently been running above 100%, which means the dividend is not comfortably covered by traditional earnings and depends on a favorable interest rate environment continuing. Analysts currently rate Dynex a buy with price targets close to where the stock is already trading, so the market seems to be saying, yes, the income is attractive, but you're getting paid to take on serious interest rate and funding cost risk, plus dilution from a share count that has jumped more than 60% in a year. Next is Capital Southwest, ticker CSWC, which is a business development company, basically a publicly traded lender that finances smaller and mid-sized companies and passes a big chunk of that interest income back to shareholders too as dividends. Over the last year, CSWC has booked around $217 million in revenue and about $85 million in net income, and it pays a monthly dividend adding up to roughly $2.55 per share per year, which shows up as a double-digit yield in the low teens. To grow, it has increased its share count by over 30% year-on-year and carries meaningful leverage. And the official payout ratio is well above 100% with negative operating and free cash flow in the last 12 months. So again, investors are being paid for taking both credit risk, if borrowers struggle in a recession, and funding risk, even though analysts still rate it a buy with modest upside from current prices. Then comes Eagle Point Credit Company, ticker ECC, which is the most high-octane income play in this group. It's tied to corporate credit, often through structured products like CLOS, so when credit markets are healthy, these structures can throw off very high cash distributions. In the past 12 months, ECC reported about $202 million in revenue and $44 million in profit, yet it currently pays a monthly dividend totaling around $68 per share annually, which translates into a headline yield north of 25% at recent prices. Far higher than what its recent earnings alone would safely support, which is why its formal payout ratio looks extremely stretched. The share price has fallen roughly 40% over the last year, even as analysts label it a strong buy, with average targets nearly 50% above the current price. But that optimism comes with a clear warning. ECC is highly sensitive to the credit cycle, so if corporate defaults rise or credit markets tighten, both the distribution and the underlying asset values can get hit hard, even though its balance sheet leverage and stock price volatility are not the highest in this list. Finally, SL Green Realty, ticker SLG, brings us into the world of office real estate. This is a big real estate investment trust focused heavily on office buildings in markets like Manhattan. So your monthly dividend here is ultimately backed by tenants paying rent, buildings staying leased, and the company's ability to refinance billions of dollars of debt in a higher rate world. Over the last year, SL Green has generated around $662 million of revenue but hovered around break-even net income. Yet it continues to pay a monthly dividend totaling about $3.09 per share annually, which shows up as a yield in roughly the 6 to 7% range depending on the day and data source. Here, the trade-off is very clear. The stock is down nearly 40% over the past 12 months and carries more than $5 billion of debt with a very high debt-to-EBITDA ratio, while profit margins have been pressured by weak office demand and high financing costs. But institutional ownership is strong, and analysts on average still rate SLG a buy with price targets roughly one-third above the current price, making it a classic distressed but potentially recovering office REIT, where investors accept volatility and real estate cycle risk in exchange for a moderate monthly yield and possible long-term upside if the office market stabilizes. For a global audience, this is a great example of how a stock can look cheap on price-to-book value and offer a solid yield while the underlying story is still very much in turnaround mode. So the dividend is not a guarantee, but a bet on an eventual recovery in occupancy, rents, and refinancing conditions. To wrap up, remember one simple rule. A monthly dividend does not make a stock safe by itself. It just means the cash is coming in more frequently, while the underlying risks remain tied to interest rates for DX, business credit quality for CSWC, leveraged credit structures for ECC, and office real estate cycles for SLG. Before buying any of these names, check whether the dividend is covered by earnings or cash flow over a full cycle. Look at how leveraged the balance sheet is compared to equity. See if management is steadily issuing new shares to fund payouts, and ask whether you personally are comfortable with that specific type of risk for the next 5 to 10 years, because that is what the market is really paying you for. If this breakdown of monthly dividend stocks helped you, consider sharing it with a friend who is chasing yield right now, and comment below which of these 4 machines, interest rate spreads, middle market lending, high-octane credit, or office real estate, you would be most comfortable holding through the next recession. That answer will tell you more about your own risk profile than any textbook ever will.